Before the college dropout put Chicago on the map, Chicago had a reputation for something else. The CME, the world's first iteration of the futures market. In the old Chicago Merchant Exchange, three men were shaking their heads in total disbelief. They had received word of a drought hitting the state of Iowa, meaning the U.S. corn production would take a heavy hit. In a panic, they started selling their shares in corn companies. A few traders noticed and are quick to follow. In a few minutes, the fire catches on. As fear spreads on the trading floor, more men decide to sell as many shares as possible. On the other side of the pit, there's one man buying all their orders. While he looks like a fool to many, in reality, this man is about to make a fortune. See, the three men who panicked and the buyer are working a scheme. The Iowa drought story was a powerful bluff. For 150 years, stock exchanges across the world were playing these psychological games with one goal in mind: to sell high and to buy low. But a new development would destroy the 150-year history of the stock market and forever change the art of trading. In 1988, the SEC introduced Regulation ATS, Alternative Trading System. It allowed people other than stock exchanges to conduct electronic trading. This birthed a new generation of traders, the digital stock traders. Firms went away from hiring smart, loudmouth extroverts to quiet types, kids who were quick with computers. One of these digital traders was Paul Rotter, aka the Flipper, a German trader who started his career in 1994 at a bank in Munich. As markets digitalized, Paul was one of the first to adapt. Within a few years, Paul Rotter became one of the most legendary online scalpers. His methods were unheard of, and he literally printed himself Ferraris. What was the secret sauce? All psychological. See, when the markets digitalized, the game changed. Trading became anonymous. Back in the day, as a day trader in the pit, you could see the orders of other big market players like Goldman Sachs. It helped you determine the flow of the market. This was all gone. Instead, the digital era introduced what's called the ladder, aka the visuals on your screen showing the string of incoming orders. This introduced a whole new game of psychology. Paul focused on the boring old bond market, long-term government bonds to be precise. A lot of his opponents were old traders from the pits who barely figured out a computer. He knew a lot of them used to front-run orders of the bigger players, and therefore, he decided to target their new blind spot. Here's how Paul typically set up his trades. First, he would flood the market with massive sell orders. Traders watching the ladder would think a big player had started selling. In an attempt to front-run the bigger players, the other traders would also sell. Then, right before his orders were filled, he canceled them and instead bought bonds, flipping directions. Before other traders realized the orders were gone, sell orders would kick in. They were too slow. Once players bought back, Paul had already profited off a few ticks. Using large trading volumes, he was able to scalp profits like this many times a day. But his strategy had one problem: he often hit his own trades, meaning he traded against himself. They called it wash trading, and it's illegal. After receiving warnings from the exchange, Paul contacted his software company, Trading Technologies. After sharing his problem, they developed a software switch called Avoid Orders That Cross. It ensured he never hit his own orders. Unknowingly, they had created a monster. Paul could now change directions in an instant, placing buy orders alongside his sell orders. It left his opponents dumbfounded. It was like getting crossed by Michael Jordan in the 80s. Before you realized what happened, he had already scored a point. In a single month, the Flipper would pull in $6 million in profits. His scalping technique would later be called spoofing, to a certain extent, become illegal. At a young age of 24, he moved to Ireland to start his own firm and take things to a whole nother level. But he wasn't the only legendary scalper out there. In 2015, the CFTC charged Chicago trader Igor B Oychester with spoofing and deployment of a manipulative and deceptive device while trading the E-mini S&P 500. Igor, aka Snuggles, was a Russian whose father taught him grandmaster-level chess at a young age. By 2004, he became one of the largest day trading scalpers in the markets. His strategy was almost identical to Paul Rotter, another so-called spoofer moving the markets. Last but not least, there was Nav, aka the Hound of Hounslow, a young Indian immigrant from the streets of London, trading out of his parents' house bedroom. He had already made his first million as a skilled scalper before he got into spoofing out of frustration. Nav was one of the first to notice lots of big players were doing it. He complained about it many times to the exchanges, but they never did anything. To fight the corrupt system, he joined the dark side and started spoofing. These three legendary day traders had global reputations. When they threw their weight around in the markets, other traders felt it. Their large volume size meant they often clashed as they tried to hit each other's trades. They printed thousands of dollars until a whole different type of trader entered their rank. Around 2007 is the year when everything started to change. While some firms dedicated their time to developing a new generation of traders, other firms were placing their bets elsewhere. Robots, high-frequency trading firms, quantitative hedge funds, whatever you want to call them, they all focused on the same thing, building computers that could out-trade humans. And by 2007, their developments had disrupted markets. The way the markets moved was starting to change. Day traders started noticing lightning fast trades and orders that were impossible to hit. We're talking hundreds of trades per second, inhuman speeds. Back in the days of the pits, a common strategy was front running. As mentioned before, it's when a big player trader puts in a trading order and a smaller trader beats them to it. Like cutting a queue in the grocery market. In the early day of the quants, it was the same. The main way robots beat traders was to front-run large traders and trends at godlike speeds. Day traders were finding it hard to make money, and as they struggled to beat their new robot competition, things only got worse. By now, Paul Rotter, aka the Flipper, had taught a new disciple at his firm, James Jimmy Chu. James Jimmy Chu was a Chinese mathematician. Chu initially made his name as a notorious scalper. He followed in his mentor's footsteps. But Chu would make a game-changing decision that would flip the tables. James Jimmy Chu decided to join the ranks of a high-frequency trading firm called Jump Trading. As an experienced scalper, James Jimmy Chu started teaching algorithms all their trading secrets. And he wasn't the only one. Over the next years, more skilled day traders started switching over to the dark side. As the quants improved their tech, their profits became undeniable. To give you an idea, by 2012, over 60% of all trades on exchanges were quants. And this number has only grown. Best performing quant of all time is Renaissance Technologies. Its flagship medallion fund returned over 40% annually this last decade. Their dominance was becoming undeniable. As more of the robots chipped away the market's arbitrages, day trading as a scalper became a dying art. Short-term legendary day traders and scalpers were becoming, for the most part, extinct. A lot of them left the game or shifted their strategy to a longer time frame in an attempt to survive. The legendary spoofers were some of the last traders who were still able to fight back against the quants to a certain degree, as their strategy directly punished front-running. They were a problem. So, what do you do when you and a few fellow quant firms are a majority of volume on the exchanges? That's right, you leverage your power and change the playing field. Due to being the majority of traders, quants were able to demand sharp cuts in trading commissions, giving them an even greater edge over their human counterparts. Seeing the writing on the wall, a lot of the legendary traders caved. Guys like Paul Rotter retired their scalping strategy. Nowadays, he still trades, but as a long-term holder from his house in the Bahamas. Yet not everybody was ready to throw in the towel. To some, this battle was about more than trading. Having lots of money always gave you an edge in beating the little guy. It didn't matter what business you were in. The financial markets were one of the few places you had a chance. Having sharper instincts and strategies could turn a broke kid into a millionaire, regardless of your background or skin color. But the introduction of quants meant once again, being rich and having connections gave you an unfair edge. While a lot of traders have voiced their frustrations with the system on Twitter and Reddit, a few take action. One of these legendary scalpers who refused to back down was Nav, aka the Hound of Hounslow. He embarked on a mission to beat the quants. Nav and a few remaining legendary traders started using their large personal capitals to develop weapons of their own. While many tried to emulate big player quants, Nav stood out. His genius made him develop a trading algo that was opposite of quants, emphasizing his spoofing strategy. But while Nav developed his own unique system, the quants made their move. Disciples like Chu, now big players of quant firms, started lobbying against the remaining spoofers. They wanted regulators to outlaw their strategy. It resulted in an all-out battle that would forever change the financial markets and decide the fate of many day traders. Tune in for the next episode where we uncover the story of Nav, his genius, and how he beat the quants. Thank you guys for watching.